Most financial crises throughout history follow a pattern that is visible only in hindsight, and people usually describe them as if they were sudden explosions. The common belief is that one morning everything is normal, and by afternoon the market has collapsed. But real collapses rarely happen like dramatic movie scenes. They don't arrive with a soundtrack, they don't announce themselves, and they certainly don't give you time to prepare. They build quietly over months or years, and on the day the collapse finally becomes visible, the system has actually been sick for a long time. The flash crash of May 6, 2010 was one of these moments where the mask fell off. It wasn't caused by a war, or a recession, or a geopolitical catastrophe. There was no terrorist attack, no corporate scandal, no major bankruptcy. Nothing that, on its own, could have justified the disappearance of $1 trillion in market value in the span of minutes. And yet, that afternoon, the market behaved as if global capitalism had been struck by lightning. At 2:32 p.m. Eastern Time, the Dow Jones Industrial Average began to move in a way that traders had never seen before. The index didn't drift downward slowly, and it didn't react to any piece of news. It simply collapsed. Within minutes, it dropped nearly 1,000 points. This was not a normal correction, it was a structural failure. Prices didn't adjust, they fell into a void. Stocks that had been trading steadily all day suddenly started printing trades at absurd levels. Shares worth $60 were selling for a single penny. Others briefly spiked to valuations so high they were meaningless. It was as if the anchors of the financial universe had been cut loose. For traders watching the screens, the experience was surreal. On the trading floor, people froze mid-sentence. Phone calls stopped. Analysts who usually shouted numbers into headsets went silent. Screens all around them flickered with price changes that had no connection to reality. Veteran traders who had lived through the dot-com collapse and the 2008 crisis stood speechless. There had been volatility before, but nothing like this. This wasn't fear, it was a malfunction. It was a system acting without human intention. Financial journalists struggled to articulate what they were seeing. On live television, you could hear the confusion in their voices. They repeated phrases like, "This can't be correct," and "Something is wrong with the feed." Some thought the data was corrupted. Others believed a fat finger error. The infamous theory that someone typed billion instead of million must have triggered the chaos. But a simple mistake couldn't send blue-chip companies to almost zero and back within minutes. Eventually, even the reporters realized the truth. The numbers on their screens were real. And then, just as suddenly as the collapse began, the market began snapping back. Stocks soared upward. Prices that had fallen off a cliff just moments before suddenly recovered most of their losses. On the charts, the entire event looked like a colossal V, a vertical plunge followed by an equally vertical recovery. The $1 trillion that had disappeared was largely restored, but the market would never be the same again. Because on that day, the world learned a terrifying truth. The financial system had evolved into something fundamentally different from what people assumed it was. It had become a machine, a fragmented, lightning-fast, algorithm-driven organism operating beyond human comprehension. To understand why the flash crash happened, we need to step back and look at what the market had become by 2010. For most of financial history, the market was a physical place. Human beings stood on floors. They shouted, negotiated, argued, hesitated, and ultimately made decisions based on judgment, intuition, and experience. They were the stabilizers of the system. Even if panic spread, there were still human instincts at play. A seasoned trader could take a breath, look around and think, "This doesn't make sense. Something is wrong. Slow down." But by 2010, this world was almost entirely gone. Technology had replaced people with algorithms operating at speeds the human brain can't even process. High-frequency trading firms, or HFTs, had become the new market makers. They weren't investors. They didn't care about long-term value or economic fundamentals. Their purpose was simple: exploit tiny imbalances and hold positions for milliseconds. In calm markets, they created the illusion of deep liquidity, a sense that there were always buyers and sellers available. But this liquidity wasn't real in a meaningful sense. It was conditional. It existed only as long as the algorithms determined it was profitable. The market, in other words, had become a fragile equilibrium. It was fast, efficient, and cheap, but brittle. On May 6th, the brittleness cracked. The crash began with a single decision that, on the surface, looked perfectly normal. A large mutual fund firm, Waddell & Reed, decided to hedge its equity exposure by selling 75,000 E-mini S&P 500 futures contracts, worth about $4.1 billion. The size wasn't unprecedented. What mattered was how the order was executed. Instead of selling gradually or using a strategy sensitive to price movements, the firm's algorithm was programmed to maintain a fixed percentage of total market volume. The problem was that the algorithm treated volume as evidence of liquidity. It didn't consider that the volume could be artificial or self-generated. As the algorithm sold contracts, it increased total trading volume. Seeing higher volume, the algorithm accelerated its selling to keep up with its percentage target. This created a feedback loop. The more it sold, the more volume it created, and the more aggressively it sold. The first buyers of these contracts were high-frequency trading firms. But HFTs don't want exposure. They flip positions instantly, searching for someone else to take the risk. On a normal day, this works smoothly. But on May 6th, real buyers, pension funds, mutual funds, long-term investors, had stepped aside because of fear surrounding Europe's sovereign debt crisis. That meant the only participants left to absorb the selling were algorithms flipping contracts to each other like a hot potato. The enormous surge in volume convinced the Waddell & Reed algorithm that liquidity was plentiful, which caused it to accelerate even more. When the selling pressure became overwhelming, the high-frequency traders simultaneously reached their risk limits and shut their systems off. In an instant, liquidity evaporated. There were no buyers left. Prices didn't fall logically. They collapsed into an empty order book. Sell orders were matched with whatever bid remained, even if that bid was a penny. This is why companies worth tens of billions traded for cents. The stock market is linked to the futures market through arbitrage algorithms. When the futures collapsed, the arbitrage systems began short-selling stocks to realign prices. That selling pressure spread the crash from Chicago to New York instantly. Most of the collapse was mechanical, a chain reaction between automated systems designed to exploit tiny mispricings but unable to cope with structural failure. The chaos continued until the Chicago Mercantile Exchange's stop-logic mechanism paused trading in the E-mini futures. This 5-second pause acted as a circuit breaker. It gave systems time to reset and allowed human traders to intervene. When the market reopened, buyers stepped in at absurdly low prices and the rapid recovery began. But the psychological impact of the flash crash didn't end with the rebound. Regulators spent months investigating the event, but their initial report failed to identify a single cause. Years later, attention shifted to a lone trader in London named Navinder Singh Sarao, who used spoofing tactics to manipulate order books. Although Sarao contributed to market instability, he wasn't the reason the system collapsed. He was a symptom, not the disease. The true cause was structural fragility, a system so fast and interconnected that a few lines of code could trigger a trillion-dollar chain reaction. The flash crash remains one of the clearest demonstrations of a vital truth. Modern markets are complex, adaptive systems. They don't behave like machines with predictable responses. They behave more like ecosystems, capable of sudden, nonlinear collapses when conditions are right. A single spark can ignite a firestorm if the environment is dry enough. The greatest danger exposed by the flash crash wasn't the loss of money. It was the realization that the financial system can fail faster than human beings can react. It was a preview of the risks inherent in a world where algorithms control liquidity, robots make pricing decisions, and microsecond-level interactions can produce trillion-dollar consequences. And this was just the beginning. In the next chapter, we will examine how the architecture of the market evolved into this fragile system, why human decision-making was removed from the core of price discovery, and how the speed of modern finance has outpaced our ability to regulate or even fully understand it. The flash crash wasn't an anomaly, it was a warning. And the question that remains is not whether it can happen again,